Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Markets. Today's topic is interest rates are falling, but borrowing costs are rising. Right? Interest rates are falling, but the borrowing costs that most individuals, most businesses, most corporations have to pay are actually going up right now. All right, this is an unusual time, and this is an unusual event within this unusual time. Now, before we get started today and talk about interest rates, I want to review a concept. And I'm going to use the equity market to do it because most people have more familiarity with the equity markets. Well, in the equity market, we have the S&P 500, right? That's a cap-weighted index. So the bigger firms have more influence, right? The Microsofts, the Apples, the Amazons, Googles, Facebooks, right? Those are the biggest U.S. companies, and they have the most influence. Another index I like to track and follow is the equally weighted S&P 500. So each member within the S&P 500 has equal representation. Microsoft has no more than anyone else. All right, that's what it amounts to. Now, the reason I like to look at both of them is at times there can be stuff going on with the smaller companies that we don't see when we look at the S&P 500 cap-weighted index, because the big firms just drowned out what's happening at times. They drowned out what's happening with the smaller companies. All right, we're going to look at something similar to that today. We're going to look at my version of an equally weighted bond index. All right, so let's get back to interest rates again. The concept is interest rates are falling, but borrowing costs are going up. So let's get started here. Interest rates are falling. Well, first of all, 10-year interest rates in the U.S., right? That's the typical benchmark for long-term interest rates. People normally talk about the 10-year interest rate or the 30-year interest rate. Well, the 10-year interest rate in the U.S. is about 0.6%, right? 60 basis points today. It's very low. The government can issue debt and pay less than 1%, right? 0.6%. The problem is that is a calculated rate, right? It's very difficult. It's almost impossible to trade that. What institutional investors, right? What the big investors trade is something called the swap rate. And that's what we're looking at on this chart. This is the 10-year U.S. swap rate. And you can see it's not 60 basis points, it's actually 70. All right. So at times the swap rate is higher than the spot rate, and sometimes it's lower. Today, it's about 10 basis points higher. All right. So on a swap rate basis, we started the year where Treasury rates were 150 basis point, or 1.5%, roughly, right? And today they're about 70. So that gives us a decline in U.S. interest rates of 120 basis points. All right. So, again, the first thing is that means the government, the Treasury, can issue debt much cheaper than they could at the start of the year. 120 basis points cheaper. 1.2%. That's a lot. That's a lot. But that's not true for you and I. Not today. Normally it is. When government interest rates go down, generally our borrowing costs go down as well. But that's not the case today. So let's go back to the chart. So what does it look like for borrowing costs for U.S. companies? So what we're looking at here is an average. Again, remember, this is my version of the equally weighted index for the bond market. So this is an equally weighted average of credit spreads. It's called option adjusted spread. But these are credit spreads. Now this covers the entire U.S. bond market, the investment grade as well as the high yield or junk. All right, so down here we have the 4 investment grades, AAA down to BBB, and then we have the 3 categories, the 3 ratings for the junk category. Okay, so now let's walk through this chart. This is a credit spread chart, right? It's a spread we pay above treasuries, that U.S. companies will have to pay above treasuries. At the start of the year, the average U.S. company was paying 225 basis points above treasuries. Okay, so remember from our previous chart, the treasuries at the start of the year were 1.5%. The credit premium then here is 2.25%. So you add those two numbers together, you get the all-in borrowing rate, the all-in borrowing costs. All right, so this 2.25% risk premium or credit premium blew out, right? During times of turmoil, it often does widen, and it blew out all the way to 7.25. So we went from 2.25 up to 7.25 at its peak. Its recent peak. It was just last week, March 23rd. Now it's come in a bit since then. It's come in a bit since then. You can see the last observation was yesterday, and it was essentially 6%. The risk premium was essentially 6%, just shy of 6%. So before we go through the rest of that chart, again, let's put the pieces together here. When we're looking at a company's borrowing cost, it's consisted of two components. There's a reference rate, all right, a base rate, a treasury rate, and then a risk premium, a credit premium, whatever you want to call it, right? So to determine a company's borrowing cost, they first won by treasury rates going down, right? The first term went down 120 basis points. The credit premium, though, the risk premium went up 400, right? It went up from about 225 and now we're 6, around 6. So let's just call it 4%, 400 basis points. So we won on 120, we lost about 4%. So overall, their borrowing costs actually went up, call it 2.5 to 3%. Their borrowing costs went up, and they went up substantially. All right, now let's go back and finish the chart here. So this was the most recent peak, right? The observation last week. Now let's go back in time here. What we have here is a peak in February of 2016. This is what's commonly referred to as the energy recession. It happened in late 2015, early 2016, and the average credit spread blew out to just over 5%. In 2011, this was the European debt crisis. Again, surprisingly, around 5%, just over 5%. March of 2008 is when Bear Stearns went under. All right, again, about 5%. So you can see these three crises were all similar in magnitude. At least the bond market was telling us those three crises were all pretty similar to one another. So as we try to put the current crisis in perspective, we can see, obviously we're quite a bit higher. We're 2% higher than we were then. So this crisis is definitely worse than some of the recent crises we've seen. Now, however, it's nowhere close to the depths of 2008, right? At the end of 2008, after Lehman Brothers went under, after Merrill Lynch had to be merged, credit spreads then were almost 12%. Today, we peaked at 7.25. Today, we're actually at 6, but last week when we peaked, we were at 7.25 versus 12. So that helps you put the current crisis in perspective, versus some of the previous crises. Now, obviously, it doesn't mean this crisis is completely over. We've peaked at 7.25 so far, and things are settling down here right now. But certainly doesn't mean that we can't go higher. But overall, again, the main concept you want to take away today is sort of making sense, understanding how it is that interest rates can be falling while borrowing costs are increasing. And again, the reason for that is that the interest rates that are falling are the treasury rates. The treasury rates are falling, but the credit risk premiums are more than offsetting that falling treasury rate, resulting in higher overall borrowing costs. All right, so that's our message for today. I'm Don Rich. You just experienced a rich insight. I hope you've enjoyed this. May your beer be colder than the company you keep. We'll talk again soon. Thank you.